Good morning, good afternoon, and good evening, whenever you may be listening, and this is Latitude, the 43 North podcast. I'm your host, Nate Benson, Digital Media Manager here at 43 North. Welcome. How are you? What's up? This is episode 45, Venture, Angel, or ICO. And this week we're talking about money, of course, with Andrea HusVar. She's a business lawyer from Lippis, Matthias, Wexler, and Friedman, a former Fullbright scholar and Western New Yorker who is doing a lot of good work in the business startup entrepreneurship scene. And it's a great insight on how to raise money and what money you should be raising, whether that's venture dollars, seeking out angels, friends, family, or even, and I know this is a big buzzword these days, ICO, or initial coin offering. So I'm not going to waste another minute wasting your time by me rambling, and let's jump right in with Andrea HusVar from Lippis, Matthias, Wexler, and Friedman. Andrea, how are you today?
I'm great. How are you, Nate?
Good. We always start out, give us the quick pitch of who you are and what you do and why you're here.
Sure. I am a business lawyer at Lippis, Matthias, Wexler, Friedman.
But who are you?
Well, besides being a business lawyer, I'm a personal investor, and I'm counsel to Impact Capital and Buffalo Capital Partners, which are investment entities that are based in upstate New York. And I'm here to talk about how to become investor ready, which I think a lot of your companies are interested in, since most of them are in capital raising mode, either now or coming up. So that's who I am.
So spoiler alert, she's a lawyer. No, that hopefully doesn't scare off any listeners. It doesn't scare me. I've had many lawyers on the show. Lawyers are wonderful people.
Yes, we are.
We all feel. So talk a little bit about your background before we jump into the thick of raising money. What was your journey to and from Buffalo? I know there was you were here, then not, then here.
Yeah, so I grew up in Western New York, not in Buffalo, but a couple hours south of here, Wellsville.
Yes, Wellsville.
Great upbringing, small little town.
Yeah. Great history in Wellsville, too.
Yeah, and I come from a family business, so entrepreneurs. And I moved to Buffalo. I was an undergrad at UB. I graduated, I'm not going to tell you when, because that's going to certainly age me. And then after that, I got a Fullbright scholarship, moved to France.
Wow, okay.
Yeah, spent a year in Bordeaux. And thought about staying, and now thinking back on it, wish I had. But, I was in my early 20s and thinking I got to figure out what I'm doing with my life. So I applied to law school.
Okay.
And then I lived in D.C., graduated from Georgetown. And after that, I knew I wanted to go into corporate work. So I moved to New York City, and I did 4 or 5 years there before I moved back upstate for family reasons.
Only 1 or 2 corporations really to work for in New York City, right?
Yeah. So I was doing large-scale transactions, mostly on the private equity side, so with later-stage companies, exit transactions, M&A. But it was a great experience. And when I got back here in 2012, I think it was the beginning of the sort of entrepreneurial growth that you're seeing in Buffalo. Mm-hmm. Which was great because I thought here I had all this great experience from New York around later stage businesses. It's easy to translate into doing work for earlier stage businesses.
Just kind of flip it basically, right?
Yeah. I mean, they have the same concerns, but
it's a scale thing, right?
Yeah. And it was like an exciting time to be in Buffalo because I had lived here in the early 2000s back when I was in school, and it was just a totally different place. So when I moved back, it was great to see that there were a lot of young people moving back, that 43 North had started up a few years after I got here. Everything that's going on with the medical corridor, all the great companies that are coming out of UB and Roswell, and just a lot going on here. So it was an exciting time to be back, and I started to refine my focus on working with entrepreneurs, both early stage. I do later stage stuff too. And I probably spend about half or 75% of my time working with earlier stage companies.
Well, I can say you're the first Fullbright scholar on the 43 North podcast, so my tip of the hat to you. So I'm not even going to try to outwit you or try to act like I know what I'm talking about, because I'm not. You've got me on that one.
You do? No, you're so modest.
No, I'm just here for the jokes.
Yeah.
And they're bad jokes.
They're great jokes.
So let's get into you deal day to day helping companies raise money. Let's clear the canvas and assume nobody knows how to raise money. So I decided I want to start a business. I want to start my startup. I know it's a startup that wants to scale. Now what?
Well, I think the first step is trying to clarify your entrepreneurial vision. And we help clients do that. A lot of times you have a great idea, but you're not really sure how to begin to grow that and how to communicate it to an investor so that you can get funded. So typically we start with the pitch deck. We will take a look at what they have and help them clarify it, ensure that it's compelling, that it's interesting, that it's not loaded down with a lot of words and multiple slides, that it makes sense, and that it's a good idea. So we typically start there. I mean, most of our clients who come to us have already formed a business, but we can certainly help with that and give them some feedback around. Sometimes they have questions around entity selection, depending on what type of business they are. But from there, we typically work with them to clarify that vision, put together their pitch deck. We help them think about their team. A lot of times entrepreneurs start off alone or with a business partner. And they really need to build a great team because investors typically invest in the team. And so that's not just your legal team, but it's your finance team, it's your strategic team. So we can assist with finding individuals locally who might sit on the board.
Why is it so much that, venture capital firms or private equity or just investors in general, why is it, and you hear this a lot, that they invest in the people, not necessarily the product? Because to the common man on the street, everyone has that golden idea, or they hear about a great idea, and you think that would be enough to sell it. So why is it kind of flipped upside down and it's the people, not the product?
Well, the product's still important, but a lot of people have great ideas, but you have to be able to execute on that idea. And if you have a team that has a track record, it's easier to get people to invest in you because you know that team can execute on the idea. So if it's a great idea, a great product, and you've got a strong team behind it, it takes a lot of risk out of the calculation, I think, for investors. And particularly if you've had success before. Now, a lot of entrepreneurs are just starting out. They they could be in their 20s and this is their first foray and they have a great idea, which is great, but there are lots of people locally who would be great on their boards or their advisory boards if they don't want to bring them onto the board. We do that. I've sit on boards. We can help you find maybe a strategic connection in your space that might be interested in joining your board, and that will provide you with that track record, that gray hair, that that confidence in what you're doing. So that's definitely a step in the process, and then you can add them to your advisory committee and your pitch deck. I think you want to be thoughtful as to who you're adding. A lot of times I see pitch decks with 50 people on it, and it's like, who are these people and what are they providing?
There can be too much advising.
Too much advising, yes, for sure. So I think you want to pick the right people, and you want to have a strong team and people who are invested in you and going to help you succeed.
And usually, Jack McGowan was saying in a podcast, which you can find in our archive, he tries to advise people to keep that slide deck about 10 slides, because after that, you start losing the interest. Does it have merit to it?
Absolutely. Yeah, Jack's great. I would definitely take his advice. 10 slides is good. I think if you get into multiple slides after that, you lose the impactfulness of your deck. And a lot of times your slide deck is being sent to people over email, and so they're just opening it up and scrolling through it. So if it's not compelling visually and it's too much information, I think you potentially lose an investor. But again, I go back to the team, because if you've got the right mix, you can send your deck to them and they'll reach out to their contacts and say, hey, I've been involved with this company for a while. I know the entrepreneur. I think this is a great product. I think it's a great team, and I'm invested in it, and I think you should too. So you can have that extra touch in there that's really helpful versus just cold emailing your pitch deck to random investors. But there are lots of great capital resources locally, and part of the deck too is determining what exactly you need, when you need it, what you're going to use it for, and at what valuation you're going to raise money at, because those are all important questions for entrepreneurs. You want to be careful not to dilute your position, but you want to be careful not to put out a valuation that doesn't make any sense.
What's the best way for a company to start developing that valuation? Do they literally just start throwing darts at a board? Do they hire someone to help them with that? What's the best course of action here?
Yeah, I mean, we help with that. If they've got an accountant or a trusted advisor, they can also help with that. A lot of it in the beginning, I think, is just kind of licking your finger and putting it up in the air, trying to figure out, what the right valuation is. And I think there are some sort of industry standards. If I think of like a software company that doesn't have any clients or customers, just starting out might be $2.5 million. So there is some parameters out there, and certainly, again, your team can help with that, and that's something that we help our clients with, developing those terms and conditions and thinking through that and what it means for them in terms of their dilution. And some of our clients, particularly in the life sciences, there are other funding sources besides private investment. I mean,
lots of grants.
There's lots of grants. Yeah. So we often advise that they seek those out first, just because they tend to be very high risk investments in the beginning, and it might be hard to get a private investor at a reasonable valuation without being significantly diluted.
One of the troubles, I wouldn't say troubles, but one of the issues with life sciences too is it's such a long game. I mean, you have from idea to, market introduction, it can be 10, 15 years after FDA approvals and testing and all that type of thing, right?
Yeah, it's a long...
And that could scare investors.
Yeah, I mean, if you think about it, in terms of what you would want to invest in, you'd want to see some liquidity in a reasonable period of time. For you and me who are a bit younger, 10 or 15 years, it's long, but, we'd eventually see it. But it'd be nice to see something in 5.
Yeah.
But they had, you have to make that decision from an investment standpoint, I think. And there are lots, like I said, there are lots of capital resources locally besides grants. I mentioned at the beginning there are 2 funds, a venture fund called Impact Capital that I'm general counsel for, and they are a Buffalo-Rochester collaboration. And they're looking to invest in companies that are revenue positive and based in upstate New York. And we just made our first investment in October in a company called CipherWorks.
Okay.
And we'll probably be rolling out this year because the fund just closed at the end of last year.
Okay.
So there should be a lot of activity there.
Very nice.
And there's another investment entity locally, Buffalo Capital Partners, which is managed by one of my partners, Scott Friedman. And they've made 8 to 10 investments over the last couple years in a variety of companies. And there's Rand Capital. There's formal angel networks like Jack's. There's informal angel networks around Buffalo, which is, high net worth individuals who partner together and invest in a variety of companies. A lot of it's word of mouth.
Yeah.
I hate to keep harping on the importance of the team, but if you have, someone who invests with a group on your board, it makes it easier to find money when you get to that point.
Right. So speaking of money, you've got your pitch deck, you've determined your valuation. What's next for a startup in terms of, because it's never easy or fun to start asking for money. And, young entrepreneurs can be excited about their idea and, make some, mistakes along the way that could impact them actually raising money.
Yeah. So obviously you need to continually refine your business plans and you need to continually adjust them. Scaling is difficult and raising money can be difficult. I think I would say stay focused, utilize as many of the resources locally as you can, including 43 North. It's a great resource that didn't exist, 4 years ago.
And there's Launch New York and the Wind Networks and various opportunities locally.
Yeah, and you have to bootstrap. My advice is, particularly if you don't have any customers, you haven't tested out whether anyone's going to buy what you're selling. If you can bootstrap through a pilot so that you can show that someone's going to actually purchase your idea, that definitely takes down the risk and makes it easier, I think, to raise money at a later stage. But I don't remember who said this, but it always stuck. It always sort of resonate with me that you needed to test fast, fail fast, and adjust fast. And
I think Michael Scott said that.
Yeah.
For you Office fans out there. When is, I think of, I always, the reporter in me always goes to the worst case scenarios of something. It's just my nature. Investor comes to a startup saying, I'm willing to give you, $1 million, $5 million, but I want you to do X with your company. And it's a significant pivot from your core values and your core mission. What's your advice, dealing with investors like that who are a little more on the front end of things, aggressive with trying to shape the company that they want, not necessarily the company you are?
I think it depends who the advice is coming from. If it's coming from a resource that has had success in the past in your particular industry, and so might have a perspective that would be of value to you, I think it's important to consider that. On the flip side, if you feel like you're being strong-armed, that's ultimately a business decision. If someone's willing to give you $1 million, I think I'd, listen very carefully. That's a lot of money around here, and it's hard to raise that. And so I think you do have to give some thought to, what they're suggesting and really think through that and, taking the funds. But again, it depends on, I think there's a lot of factors involved in that analysis.
At what point should, a startup founder realize, hey, maybe I'm out of my element. It's now time to start looking, for a professional legal counsel to help oversee a raise or something like that?
I would say the sooner the better. I know this is coming from a lawyer, so it's probably a little bit biased, but honestly, the sooner the better because, like I said, we can get you properly set up, help you think through the terms, ensure that when you go out to market to raise that you've thought about how much you truly, truly need. Maybe you don't need $1 million, maybe you need 200,000, and that could lessen the dilution on you over time. We might be able to help and say, oh, you haven't started a pilot program yet. Here is one of our, strategic contacts that would love this program, love this product or service. Let us connect them with you and see if you can get a pilot underway. We can provide sort of strategic and advisory advice. I feel very lucky to be a partner at Lippis because the history around the firm has always been very business-minded. And so we provide more comprehensive advice than just legal. We really care about the clients that we work with, and we try to think more business-minded, what's important to them, and how can we help them? How can we connect them to people that are going to help their business, and what can we do, even just outside the paperwork? So that's always been key to the work that I do with clients.
What are some of those early mistakes, or some of those corners that founders put themselves in early on that kind of could make or break that you've seen maybe in some of the deals you've had to put together?
Oh, that's a good question.
That's the only one of this podcast, so it's all downhill from here.
So I'm going to have a roundabout answer, but I would say I think you have to be flexible and humble. In addition to the work that I do with earlier stage businesses, I also work with later stage businesses, especially family businesses, which are very entrepreneurial, particularly with the next gen coming up. They tend to take over from their parents and then want to start a different division or a different product or a different service. And so they have all the same issues that an early stage company does, maybe without the issues around cash flow. And
an issue there is my generation thinks we know everything, and the older generation thinks they know everything, and then we start butting heads.
Well, just being humble, I think, having humility, recognizing that others might know more than you, listening to their viewpoints. Fear is a big issue, fear that someone else is going to eclipse you. I think to have a successful business, you need a team, and you need people with strengths that you don't have. And so if you're open to that and not too concerned about, retaining, control and all decision making, and you provide some flexibility there to bring people onto your team that might be better at something than you are, I think that can really add value. But that goes back to knowing that you don't know everything and that you need help. And it's okay to ask for help. So that would be, I would say, try to remain flexible, open, don't give up who you are, but, build out your team.
So, Andrea, we've had a few guests on this podcast, shifting away from the traditional ways of starting up, getting your venture capital, angels, mom and pa and your friends and family. Those are kind of the big four traditional ways to start up, and that's the path most people take. In the last 12 months or so, we've seen an influx of ICOs, initial coin offerings, people getting on the blockchain. Whether or not any startup necessarily knows what that means, they just see a headline, Nate's Nacho Stand raises $50 million on an ICO. Yep. That's appealing. You've dealt with blockchain a little bit. Talk me through how you and a team have kind of integrated blockchain into assisting startups.
Sure. So it is an emerging area of law. I would say over a year ago, a lot of law firms weren't even thinking about digital assets or cryptocurrencies. And I'm getting, and my colleagues are getting, calls every week for assistance with ICOs, crypto hedge funds, all sorts of questions around digital assets and cryptocurrencies. So it is an emerging area of law. We started a practice group at Lippis. It's headed by a colleague of mine, Sarah Brennan. And I'm on it, as are a few of my other colleagues who I work closely with on the more traditional investment side, Scott Friedman and Eliza Friedman. And then we have people from our litigation group like Dennis Vacco and a FinTech group, Brian Bicchetti, and others in the group. So we have a pretty fulsome group, and we are continuing to build out that practice, and it is a viable way to raise funding that is not through the traditional sort of channels. So if you're a company out there that's looking to do something non-traditional, give us a call. It's something that an area that we're continuing to develop. How
you guys are looking into the viability of doing something like this, but like almost on a daily or especially on a weekly basis, you're seeing headlines, ICO turned out to be Ponzi scheme, and, $40 million is now lost kind of up there. And I'm pointing up to the clouds and the blockchain. From a legal standpoint, how do you determine someone, startup coming to you, hey, I want to do an ICO, we're going to do this, seeing through that as legitimate or, nonsense?
Well, it can definitely be accomplished. You might still be depending on where you are in the evolution of your business, it may likely still be subject to the securities rules. And you may only be able to offer it to what are called accredited investors, meaning that they can, if they were to lose their investment, that would be okay. So sometimes the initial raise is still subject to the security rules. And once you get past that, then you can offer more broadly, but it's, again, a developing area of law, and there are releases coming out like weekly around what we can and can't do, so we're continuing to monitor that.
And that's all coming from the SEC or?
The SEC, other regulatory agencies. So, again, it's a viable way for raising money. And who you're able to raise from now will depend on your particular facts and circumstances of where you are in the business. If, for example, your token doesn't have utility yet, you may be still subject to the securities laws, and we have to raise from accredited investors, which is totally fine. And then you may be ready to raise from the general public as you move past that and your token has utility. So, again, it's a viable option, and I think it's going to be huge in the years to come and may even change how people invest. We'll see. I mean, the SEC is starting to catch up to this area of law, so it may be highly regulated and regulated just like investments are regulated today.
Which, of course, stabs those with cryptocurrency in their heart at the very core, because it's such a libertarian, non-government involvement.
Those millennials,
I know.
They don't like rules,
and we hate everything and love everything. It's a weird generation.
It's a great generation. It's changing how we do business, which is really exciting.
Yeah. What would your advice be, for a company? They've got, they've laid out their vision, they can go venture capital, angel route, they could go blockchain ICO route. How do you decide?
Well, I think you do everything. You can start going the traditional route with local resources. I think I go back to it's tough to raise money. So you may have to look to you may have to take multiple steps to do that. Again, I feel like I'm harping on this point, but if you build the right team, that can really help you. Mm-hmm. A lot of investing is having the right relationships, and people with track records or strategic connections on your board can provide confidence in the investment to other investors who might be within their network. And then if you're not getting a lot of traction there, an ICO is always a possibility, but I think you really need to look hard at why people aren't investing in you. Is it because, is your product a good one? Will people buy it? Is it needed? Are you raising at too high of a valuation? Are you doing this part-time and not, fully all in every day, which is causing people to be concerned that it's sort of a side project for you?
Yeah. Are you even implementing the blockchain, efficiently?
Yeah, I mean, whether you're raising money through a regular investment or an ICO, you got to have a good product. I mean, no one wants to invest either from the general public or from accredited investors in something that doesn't have value.
Yeah.
I mean, why would you? So if you're having challenges raising, I think you need to look at your business model and like I said, go back and do you need to make adjustments? Do you need to pivot? Do you need to add someone to your team? Do you need to jump in full time? Those are all questions I think you need to ask.
Well, I think, an avenue of investing that, has arisen in the last, 5 to 7 years that I find fascinating, and most people probably wouldn't equate it to actual investing, but is something like Kickstarter.
Great. I love Kickstarter.
I've, backed, so to speak, probably a dozen different projects. Only 4 have actually come to fruition, mm-hmm. which is partially annoying and partially like, okay, well, like if you compare that to startup life, one in 10 startups succeed. Well, 4 of 12 have succeeded, so I'm okay there. Some of those companies folded after a few months. So like really it's across the spectrum of just, there's risk in anything, and I think most, people on the street are familiar with Kickstarter, obviously, and, probably not equating that to a form of investment, but it really is.
I'm glad you brought up Kickstarter. Kickstarter is a great way to raise money, and I want to be careful about that because in Kickstarter, as you know, you're not investing in a security. Mm-hmm. You're essentially donating funding in exchange for some sort of product back, which is why it's unregulated. But for retail clients, people who have a retail product, Kickstarter is great. I have clients who have raised $100,000 on Kickstarter, but it's for a specific type of industry. It'd probably be hard to do that if you're a medical device.
Right,
I mean,
right.
You wouldn't do that. But if, I don't know, you sell comic books or you've got, some other retail-based company, that Kickstarter can generate some great initial funding for you in the beginning when it's very, very difficult to raise funding.
And even established brands, have launched products on Kickstarter and other platforms similar to that, just to kind of gauge interest in like, would this sell? How much would it sell for? Sneakers, for example.
Yeah.
$249 for, high-end flashy color sneakers that, they wouldn't necessarily put into a store, but you can do that on Kickstarter and immediately make a profit on it because you can make $50,000 and be done with it.
Yeah. It's a great resource. But something you have to think about based on what industry you're in and what product or service you're selling.
So wrapping things up, I guess the conclusion we're getting to here is there's money out there, and you have to spend time figuring out your path to get it, right? Yeah,
you do. And I think it's important to do that. Again, I go back to starting with clarifying your entrepreneurial vision, communicating that in a pitch deck that is short and compelling, trying to start a pilot program that you bootstrap so that you can see if it's of interest to other people. If it is, then you can start thinking about developing some terms and conditions for a raise, build your team, get some great advisors, and whether they're business advisors, legal advisors, financial advisors, get them on your board, continue to define, refine, and develop and pivot on your business plan and put it all together. And I think you have a compelling pitch for your first sort of organized capital. And then you got to hit the street and try and raise as much as you can locally. And there are lots of, not just locally, but there are resources in New York if you want to head that way. And there's always, this ICO. Mm-hmm. So, or Kickstarter. So there are a lot of resources, but I think you need to prepare before you get there. That's really, sort of the conversation that we had around this podcast is how do you get investor ready? Taking all those steps so that when you're ready to raise funding, you're, there.
I'm seeing an influx of people walking towards us, so I don't know if we're being kicked out or not. Andrea, if people want to know more about what you do or connect, how can they do that?
So I am on the Lippis Matthias Wexler Friedman website, Andrea HusVar. My number and my email are up there. You can find me on LinkedIn as well. Just reach out to me. I'm happy to talk about any of this. I mean, if you're interested in forming a business, if you're looking to raise capital, if you're thinking about an ICO but don't know how to get started, happy to help.
Andrea, thanks for joining us on the podcast, and hopefully I lived up to your expectations. I know
you did. I love this. I feel sad that we're ending.
I know. Well, we'll have you back, I promise.
Well, thank you.
We'll see you on down the road. Thank you.
Thanks so much. Bye-bye.
I want to thank Andrea again for joining me on the podcast. Again, you can head over to the Lippis Matthias website to learn more about Andrea and connect with her. And you can also find her on LinkedIn and probably other mediums as well. Next week, we've got a great episode with the managing director of 1,000 Angels, Erica Dogman-Minahan, and we talk a little bit about 1,000 Angels, but also the accelerator program 43 North and 1,000 Angels have partnered together to create for Western New York startups. And it's a really great program that just started a couple weeks ago. So, it's pretty cool, pretty fun. Hey, if you haven't done so already, please subscribe to this podcast, but you're listening to it, so you most likely have subscribed. So tell your friends and family and anyone else you know to subscribe as well. And hey, if you haven't done so already, and I know some of you have, and some of you haven't, and I know who you are, head on over to iTunes and leave a 5-star review of this podcast. Again, as I say every week, the more people who review, the more people who will hear this podcast, and we want to share the message of the Buffalo startup scene with everyone. I'm Nate Benson for 43 North. Thanks again for listening, and we'll see you at the next one.